Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook and your host for about the next 20 minutes here. Today is Friday, May 24th, 2024. The markets are open and NVIDIA announced a stock split. This Wednesday, we didn't place a trade on NVIDIA around earnings, which we usually would do, but we had a huge summit within the Tradier hub. That was also sponsored with the Chicago Board Option Exchange, otherwise known as SIBO Global Markets, which is their new name at this point in time. I really wish they would go back to their old one. But with that said, NVIDIA, well, the response was solid. They had a solid earnings report, which everybody expected. They didn't necessarily blow the doors out in that they kind of matched the whisper numbers, but the 10-for-1 stock split was more than enough to announcement was enough to drive that stock higher. They went up over 100 points at this point in time. Right now we see it trading at 1,049.07. It's up another 1% today, or $10.80. So in the NVIDIA position that we have in the paper trading portfolio account, we're actually going to look at how the whole position was managed, because whenever you have a position that has done well, it hurts sometimes to actually manage that position, because you do need to keep your everything inside that portfolio equal weighted. And that's one way to manage risk. And it's always hard to do on an underlying that you just think can't go down. The thing about every underlying stock is that even though they can't go down, they still do. Even though they shouldn't, they still will. And so it's important that you still have the benefit of the movement of the underlying stock because of your forecast and that, but to also every once in a while take some money off the table, ring the cash register, adjust your position. And I'm going to go through an entire position of NVIDIA and all the different trades that we did now after the earnings reports, and how you might want to start a new position in NVIDIA. But the stock is going through the 10-for-1 stock split. That means if you have 10 option contracts, if we had one option contract, which that's what we started with in the NVIDIA position, that one contract's going to turn into 10. And it's a straightforward because it's a 10-for-1 split. So I will actually put together an article about what's going to happen to your NVIDIA position. That's what my plan is. And but it's pretty straightforward because it is a nice round split. 10-for-1 is very straightforward on $1,000 stock. Okay. So today we're going to go and look at our SPX position. We put this on. We struggled a little bit with a couple of our SPX positions because the market, for some reason, didn't want to pause when we were setting all-time highs. We just blew through the all-time highs. The market, just in general, we were bullish over the last 3 or 4 trades. Looked at last week a movement in the butterfly. We were set up right around the new high, the new all-time high in the S&P 500 index. And the stock didn't even pause for a second. So we were forced to get out of the position. That would have been a losing trade. Went back to it again. It was still kind of with the same thought that the market's got to just slow down for a little bit and put on another SPX butterfly position. And that position is going to work out, offset a little bit of the loss. But in hindsight, over since back in November, since we really started putting together all these SPX positions week in and week out, we've done extremely solid on most of the positions. Every once in a while, you just have to be able to manage the risk and adjust that trade. So I do think we're going to do another one of these next week. And I don't want to put it on today. I don't want to get it all set up and have the weekend. I'd like the way the markets have been. The VIX is down a little bit, right? So, and that usually will happen when you're setting an all-time high. The VIX is trading right around that 12 level, which I'd prefer to have the VIX a little bit higher when you're trading SPX options or just some options in general. Maybe next week I might change it up a little bit, and I think we're going to look at the NASDAQ. I think we might, instead of just to be different, instead of doing a trade in the SPX options, we will use the same concepts, and we will do it in the NASDAQ. And then we definitely want to wait until Monday on that trade. So here's the SPX trade, and let's run to the TradeHawk software now. And we have inside this trade, we're looking at today's expiration, which is the 24th. The market is at 53.05. When we put this trade on, we got a net credit of 40 cents to the account. It was flopping around between 40 and 50 cents when we're putting the trade on during that day. The market was at 53.25. So if we look at the trade that we put on around a 1 standard deviation out, we're looking at 53.90. So if we just even look at that one option contract at 53.90, we see that that is trading 0 by 5 cents. So no need to look at anything else, right? The SPX and the skip strike butterfly, as I've always said, is I look at it as an alternative to doing a short call spread. So the short call spread basically expired worthless this week, if you will. And that also meant that our butterfly expired worthless this week. So with that said, we made the net credit for the account. So this was a much better trade this week than doing a long call butterfly spread, where if the markets go down, we'd have to roll that into a butterfly. I'm sorry, a long call spread that we would adjust into a butterfly. So even though we were leaning towards the bullish side a little bit on our skip strike butterfly, giving ourselves a little bit of upside, ultimately we did something that was neutral to bullish on the marketplace. And also, you could also say bearish, because if the market goes down, we still did okay on the trade. And that's the beauty of the skip strike butterfly. And so this week, we're going to stick with that theme, and we're going to come back on Monday, and we're going to look at at this point in time, I'm pretty sure that I'm going to look at the skip strike butterfly in the NDX. Now, excuse me. So let's go and look at NVIDIA. And I just want to kind of point out in NVIDIA that we are now up $10 on the stock. The implied volatility is still, it's tight on the shorter term option contracts, which isn't always as accurate. When you get closer to the expiration date, implied volatilities in delta and gamma, they kind of fail a little bit. The pricing models do a much better job when you got some time value in them. But if we're going to start a new position on NVIDIA, because I think there's a lot of people that are going to be coming to the marketplace, I don't mind doing it after earnings. I'd give maybe a day or so for this to play out. But the pundits are finally starting to say that, well, I don't know about finally, but there's been a lot on the major networks that a lot of the pundits are saying it's time to take a little bit of profit. Going into the summer, had the big run up in the underlying stock. Maybe it's time to trim your position a little bit. We already trimmed inside our paper trading portfolio, but after earnings, if I can see a vol drop, and it's all really about the vol, if I can get the vol to come back down to somewhere around that 30% range, I don't mind going out further in time and looking at a longer term option contract that let's go out about a year. So 392 days would be that June expiration of next year. Going deeper in the money, you got to go. If you go deep in the money, you're going to be paying some dollars for it, because we already ran into that. But we're looking at $342 as opposed to a $1,000 stock. But we're going to do the stock split, and I would want to do this before the split, and which is going to happen in June. But you have $1,000, or you have, if you take 100 times this contract here, this is the 80 delta option right here. Let's do this one. We'll do the ask price on this times 338. We're talking about $33,000, $33,800 total. And if you have $1,046 stock times 100, you're talking about $104,600. So that's the alternative. You're going to get something that acts a lot like the stock. You got 1 year outlook. This is how we started our position back in November. We manage the position. The biggest issue is always dealing with bid-ask spreads. The deeper you get in the money, NVIDIA is obviously very liquid, but we're still got a $2 bid-ask spread. You're going to have to manage that trade. And yeah, that's basically the way we're going to look at that trade. Now, I do actually forgot to mention that on Monday is Memorial Day. So the markets are going to be closed. It's a market holiday on Monday. And so haven't quite decided either. We're going to do the taping of the show. We're going to go down the road of NVIDIA and talk a lot about that position, or we're going to come back and actually do a live show. We might be pushing it off till Tuesday. So make sure you check your email and see when the next show of Options Guide TV is going to be. All right. So if you have any questions on the skip strike butterfly, please put them in the chat box. If not, I'm going to go and look at NVIDIA, and we're going to probably set up that trade and take a peek at it. We're going to probably want to do this. We're going to want to do this on Tuesday. Oh, and of course, I just froze. 1 second. There we go. So there's the NDX. Monday is the market holiday. So we're going to be looking at the NDX next week. The 31st is going to be the Friday. So then we're going to look at that expiration. And we're going to take a peek at how we would set that trade up. So let's come all the way back to the beginning here. And we're looking at the 31st, which is 7 days away right now. And we're looking at a 1 standard deviation move. Now, this index is an $18,000 index. So it gets more interesting because of the total valuation of the index. So we can go a little bit wider on it, which I prefer to do that. But the thing about it is you're going to have a larger requirement, which is part of the reason I like the SPX for the valuation. Being a $5,000 index versus an $18,000 index really affects the premium and how wide you can go. You've got to get fairly wide in the NASDAQ in order for, if the market starts coming towards your short strike, that you can actually get some profit and some premium on that trade. So $3,000 is going to be the requirement. On our SPX trades, we're almost always within $1,000 to $2,000 on the requirement, but we're just going to have to go a little bit wider on this underline. So I think here we're going to do I guess we'll do 25 points at this with this setup based off of the strikes that are available. So we're going to look at 1 standard deviation move. This is the 16 delta right here at 1931. If we were going to set this up today, which this isn't the official paper trade for the week, we're going to wait until Tuesday, especially because of the Monday holiday. So we're going to buy this one. We're going to sell 2 of the 19,150. So it's even hard to even just talk about it. Then 19,175. We'll just call that the 175. That's the one we're going to skip, and we're going to go to the 200. And 1 by 2 by 1. We're getting a midpoint net credit of $2.15, $2.10, but we are 25 points wide. So now we're a little bit more on the requirement. It's a little bit more risky to trade this in the NDX, and that would be about $2,500 for every 1 by 2 by 1 butterfly that we put on. And I'm going to send this to the what if calculator. I don't know why I have a stuffy nose today. All right, so let's pull this down. And we're going to zoom in a little bit on the trade. Okay, so here's where the market is at right now. And you see, if you look at the SPX, this distance from here to here, you need a lot more time decay in order for this trade to end up panning out. So in the SPX, if the market goes right here, right now, we're down $700 on that trade. And that's a function of the fact that we went wider on our strikes, as opposed to when we're looking at it in the SPX trade, we are a little bit more narrow on our strikes. So you have more overall risk. So if the market moves fast in our direction, well, then if this happens and it moves fast in our direction, it hurts us sooner on the trade. So let's go in and see what happens over time. If we put this trade on, We're going to go all the way to Monday. Monday's a holiday. We'll go to Tuesday. Okay. Tuesday at 11 o'clock. Now we're looking a little bit better. We go again. Let's go to Wednesday. Let's go Thursday. And now anywhere within this range from where the stock is at, remember the stock's right down here. We're pretty solid until we get all the way up to that strike. But now the tide's going to turn. So we go to Friday, and now we're profitable on that trade. And then let's add a couple of hours. Let's go to 13.19 on the what-if calculator. And when we do that, now what has to happen between here and the market close a couple hours later is this is going to dramatically go towards the profit and loss at the expiration date. So this is the trade at expiration. This is our maximum risk down here, $2,275, which is $2,500 minus the net credit that was received or brought in. So I'll go and show you this inside the options playbook. So let's zoom out here just for a second. And I will pull up the playbook and we'll look at the skip strike butterfly there. So if you have any questions, please, if you are in the Tradier YouTube platform, you can actually answer those questions. We're going to look to add that capability inside the Tradier Hub in the short term. And you could also be watching this on x.com. If you're following my Twitter, which is at Brian Overby, you can actually review all of the option guide TVs. Very simple. Just get an alert in x.com and you'll be able to check that out. Okay, so here is the skip strike butterfly. So let's run to the options playbook. We're going to blow this up a little bit. So here is the setup. Very simple. We're going to buy a stock at strike A. This is strike A. The market is over here. We're going to sell 2 at strike B. And here, hence the reason why I talk about the skip strike. We want to skip this strike. If it was a standard butterfly, we wouldn't skip it. We would buy it, and it would be a net debit, limited and known risk to the net debit that you paid for it. That's a standard butterfly. By skipping the strike, we're basically embedding a short call spread inside our butterfly. That short call spread is paying for our standard butterfly. So we skip the strike, buy strike D, get it done for a net credit to the account. But the only way this maxes out is closer to the expiration date. So NDX, we're getting a solid amount that we're bringing in for doing that trade. If you want to learn more about the skip strike butterfly, please go to optionsplaybook.com. And if I look and see if we have any questions or comments, not a ton. Have a great holiday weekend. And we will come back on, well, I guess we'll say on Wednesday. And we will take a peek at a skip strike butterfly inside the NDX. Thanks for stopping in, and we'll hope to see you in the hub on Wednesday.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.